Broadcasting live from the Subaru of Gwinnett Studios in Atlanta, it's time for On the Money, presented by Embassy National Bank. Now, here's your host, Joe Moss.
The number one small business show on Business Radio X. The show is presented by Embassy National Bank, and we are a nationally chartered financial institution whose deposits are insured by the FDIC. We discuss topics that are designed to help small business succeed because at Embassy we love what we do for small business. I'm Joe Moss, your host and president at Embassy National Bank, and we're broadcasting from the Subaru of Gwinnett studio. Today, we're going to announce a couple things, and we've got a really good guest on the show. Mr. Tom Hogan joins us today. Hey, Tom.
Hello.
And Tom is at Embassy, we've created now a residential mortgage business line, and Tom has been handpicked to head this effort up. So, Tom, why don't you give us a little background, and then we're going to talk residential mortgages.
Sure. Well, listen, I appreciate the opportunity to be with you today. My name is Thomas Hogan. I am from here in Atlanta, down in Chamblee. I have about 18 years experience in the residential mortgage business, specifically here in the Atlanta market. I took the opportunity to come to Embassy National Bank to create a full-service residential mortgage division for the bank. There's a lot of opportunity on the consumer side for the bank, and I think that we've done a good job in getting a department set up that has both a very highly competitive rate and fee structure, as well as a wide expanse of loan products that include both the conventional FHA and VA that everybody's accustomed to having, but we've also got some very niche products that are made available through some of the investors that we work with.
Yeah, and we're excited about having Tom, and we've got big hopes for our mortgage department. A lot has changed within the residential mortgage industry. I think that's fair, right, Tom?
Oh, absolutely.
And let's just kind of give a background. I guess it all started. You need to add that you're on the city council at the city of Chamblee.
All right. Fair enough.
City council member in Chamblee.
Fair enough. Anyway. Thank you.
A lot, I guess, because of the meltdown. Just if we can kind of go back and talk about how we got to where we are. Then Dodd-Frank came along. Mm-hmm. And Dodd-Frank put a lot of rules and regs onto the residential mortgage business to try to prevent the meltdown from ever occurring again, and as I jokingly like to say, to make sure that you are protected from me when you're doing a residential mortgage. Obviously, there was a lot of greed and everything that happened and through all that, but at the end of the day, it is what it is, and so now Dodd-Frank is starting to implement a lot of its rules and regs.
Yeah. I think a fair thing to say is that back in the early 2000s, before the great bust, there was just so much optimism in the financial markets because we were experiencing unprecedented growth. Policymakers on the federal level really wanted to expand the opportunity for home ownership. They really lowered the bar in so many ways, but that was not alone what got us in trouble. The financial markets started to get increasingly sophisticated as folks were incentivized to bundle and package really big deals. And hindsight's always 20/20. But I used to joke with some of the loan officers that worked for me at the time that if you have a 780 credit score, it's fairly a good indication that you pay your bills. I did not have a problem with folks stating their income or stating their assets because it was very well proven, that they did not fail on their obligations. However, I think that there was a lot going on beyond the scope of my own practice. A lot of the pay option arms with negative amortizing loans, interest-only features with 100% loan to values, things that just really weren't prepared for a significant change in values in the marketplace. So, prior to the big bust, there certainly were plenty of regulations already in place. I think that there was a lot of concern from some of the smaller producers like myself at the time that were concerned that a lot of them weren't being enforced. frankly. There were a lot of kickbacks, a lot of quote-unquote marketing agreements that were just really disguised kickbacks that mortgage loan officers were able to give to construction lenders and real estate agents and that sort of thing. And I think that one of the things that the bust did on a lot of fronts, not just the mortgage industry, was it brought a lot of crystallization to prudent business practices. And, so then you had a bunch of regulators who I think we can all agree, really do a lot of knee-jerk reaction in response to a lot of the things that are failing. They did go after a lot of regulatory issues, but one of the things that did come from it was a change in how it is that we do business. And I can honestly tell you that the compliance process when you work with a good organization is going to have that paperwork prepared in a way where it makes sense. It's easily explained to you. And you should, as a good consumer, see that the new documents disclose the information to you with much more clarity now, and in terms that we're all accustomed to wanting to see and seeing and understanding than in the past.
Now, a lot of phrases. I mean, I've been in the mortgage business as well, but I got away from it, and then I come back in after Dodd-Frank has passed, and all the phraseology seems to be different. The closing statements are different. The ways to get paid for originating loan are different. So a lot of those things have changed, qualifications. Let me just ask you about a couple of those. There's this phrase out there about qualified mortgage and a non-qualified mortgage.
Sure.
What is that?
A qualified mortgage is a mortgage that does not have certain features attached to it. A qualified mortgage is a loan that does not have a balloon payment. It doesn't have a prepayment penalty or an interest-only feature or a negative amortization. It has under certain circumstances, it is a loan that has a debt ratio that is below 43%, which we can talk about a little bit more down the road here. And the points and fees have to be less than 3% of your loan amount. So that creates a standard for a plain vanilla loan, as probably you and I would probably call it outside of the terminology.
And
here.
then in a normal event, if you're a reasonably smart consumer with your eyes wide open, that's the only kind of loan that you would really want to get, isn't it?
Well, and if you're sure. I mean, I think that if you are it really depends on the borrower's needs. I mean, I think that it's fair to say that the more sophisticated the advisor and the more sophisticated the borrower, sometimes those loan products do come into play as being meaningful financial tools. But truth be known, over the course of the past year or so, I don't know that I've written anything other than plain vanilla fixed rate mortgage, or maybe one or two ARMs, only because the rates are so low, and unless you really are planning to not be in that loan for very long, with money costing what it does today, it just doesn't make a lot of sense to put yourself at jeopardy of that rate changing.
But the ARM adjustable rate does not make it a non-qualified mortgage.
Does not.
Okay.
Yeah, you're right.
Okay, and okay, so the non-qualified mortgage then is everything else.
That's right.
And isn't there a feeling that about the legislation, they really didn't want financial institutions or mortgage bankers to make a non-QM? So wasn't there some liability they assessed across the board?
They did, and I think one of the things that they did instead of phrasing it that they did not want it to occur, I just think they wanted the financial institution to take a little bit more responsibility for putting their money where their mouth is. And if they're going to make a recommendation for a certain type of loan product, that they should have some accountability for making sure that the borrower could repay the loan. We've got this new terminology called ability to repay in the mortgage world now. And it is, there are 8 factors that a borrower has to be assessed on to make sure that that they've got it together. We talk about them having reliable income, reliable employment, having an affordable mortgage payment, affordable, total mortgage payment, which in the business we call a PITIA. That's the principal and interest, which is the mortgage, taxes, and insurance, and if they've got homeowners insurance.
Assessments, yeah.
Right. total debt ratio, reliable credit rating. And then, one of the things that they have us do is sign off on the fact that we used reliable documents to actually confirm that ability to repay exists.
So irrespective of QM versus non-QM, you still have to have the ability to repay.
We got ability to repay, and it cannot be a high-priced loan. We've got it's a three-legged stool, because a high-priced loan, we have this average price over rate, which is a published rate that's a cost of funds derived number, and that APOR plus a 1.5 for a first mortgage or a 3.5 for a second mortgage, your APR can't be higher than that, or you're in a higher priced loan, which puts the lender in even more of a liability position. So when we approach a borrower, we're really testing first and foremost to make sure that borrower's in a qualified mortgage. We're also then doing a side test on whether it's a high-priced loan. Mm-hmm. And then finally, we're doing a test to make sure that they have the ability to repay. And, in an old-fashioned sense, I mean, this is what we should have been doing the whole time. I've always said that, to me, the quality lender or the quality banker is a debt-side financial advisor, that we just don't do a mortgage product in a bubble and just pretend like all the rest of your liabilities and your income and all that stuff doesn't exist, that we don't just smack you on the bottom and send you down the road. The reality is that it takes a lot of discipline to make sure that the loan product, against maybe possibly the wishes of the borrower, are actually prudent and suitable for what they are saying that they need.
So with all these rules in place as dictated by legislation, and by the way, you also have the CFPD out of Dallas that are coming in and looking at things as well. How does one lender differentiate himself from another lender?
Well, we all have the QM products, your plain vanilla Fannie Mae, Freddie Mac type products. But one of the things that we're seeing is that each of the investors is putting together a portfolio of specialty loan products these are what are called non-QM or alt-QM, ALT for alternative. Mm-hmm. The alt-QM products are, by themselves, they're not the boogeyman. I mean, these are not bad loan products. These are not dangerous. These are not irresponsible. They're just not qualified mortgages. And I think that it's nice as an initial sort of flag for the borrower to know that this is not an ordinary loan, and therefore maybe they'll proceed with a little more caution. But the all-QM product is phenomenal. I mean, we have, even at the bank, we have an asset depletion program for high net worth individuals. If you have a couple of $1 million in the bank, I can actually use a calculation to understand that as a function of producing an income for you. And if you don't work and don't derive an actual W-2 or a 1099 from some activity, I can still qualify you for a mortgage because they have a method that they've used to determine what that income level is going to be. Mm-hmm. Okay. Another great example is foreign nationals. We have a phenomenal program for people that are not U.S. citizens and don't have a green card. These folks are foreign nationals, and we have a situation where, in most cases, you need not only to be a citizen, but also to have a social security number, but also in a lot of cases to be a citizen here to get a loan. And on the surface, that makes a lot of sense. However, one of our investors has figured a way to be able to qualify the creditworthiness of someone that is not from here, because the barriers around the country are going down, and we've got an international financial market going on all the time. And a third way is for business owners, something that we deal with a lot at the bank.
Right.
We actually have a method for being able to use bank statements and deposits into those bank statements in order to calculate that as their income. A lot of people have a lot of incentive to write off a lot of their income for tax purposes.
Well, for a while after Dodd-Frank was created and the rules were being formulated, the only product I remember being out there was basically QM product. It was really hard to get a non-QM product, and everybody was really tough on the ability to repay. So in a lot of respects, the markets were closed except unless you were a W-2 person that fit all the right boxes. But now what I hear you saying is starting to open up again.
Yeah, I think it's fair to say that there are, and there will continue to always be, more and more loan products coming back into the market. I mean, I think it's fair to say that both the equity side of our marketplace and the debt side of our marketplace are, they're very sophisticated places where very smart people go to work. And taking a look at actuarial information on default rates and what risk there really is, people are, they're looking for places to be able to put their money to be able to drive a good investment. And if it's collateralized and you have a reasonable, a reasonable report that shows that, people are going to pay their bills, then I think that it possibly is good. I think that, just like anything else, there's a lot of shysters out there on both sides of the ball. And, it really is up to a borrower to make sure that they're really working with somebody that they can trust. I mean, I think that I have all the respect in the world for brokers and mortgage companies, for example. Mm-hmm. But I think one of the reasons I chose to come to work with you at the bank is because I really do think that we've entered a time where trust is really important. And obviously we at the bank, due to the nature of how we're regulated, come under a crazy amount of scrutiny. And people don't really just have to take my word for it. Mm-hmm. I mean, they can heed my advice and hear my rationale and listen to all the ways that I can describe what it is that I'm offering them and why it's good. But at the end of the day, they know that there is a federal regulation entity that's going to come in and make sure that I did absolutely the best for that client.
Right. Let's talk about the debt ratios that are out there today, mm-hmm. and if you minimum credit scores, debt ratios, the limit on the Fannie Mae product or the FHA product, and where to go if need a higher loan amount, all those types of things. So let's start with the debt ratios. Is there a maximum debt ratio that you can have these days?
There is. A qualified mortgage, like I said before, is a debt ratio below 43%.
Right.
But truth be known is you can go all the way up to, with most investors, to what the automated underwriting engines for Fannie Mae and Freddie Mac will actually allow. And that's usually up to 50%.
Okay. And then secondary to that, there's a W-2 as a percent of the mortgage payment. Is that correct?
No.
Or how do you calculate there's a two-tier percentage, correct?
Right. The debt ratios are into what's called a front-end ratio and a back-end ratio.
And that's the way it's always been.
There are two measures that they're looking at. One, they really want to make sure that you don't go over a total limit for your total debt. Like if you make $10,000 a month, they really don't want you to have regular minimum monthly liabilities at over $4,300.
Okay.
In addition to that, they don't want all of that to be in housing. They understand, prudence means that some of that needs to be for things other than just than housing. So
like a car.
So they what they do is they create what's called a front end ratio. So they say, well, listen, maybe 28 or 30% just to housing and 43% total, and then those really aren't set in stone. So they really are kind of targets that we shoot for, making sure that when we're advising people that we're making sure that they're staying within some, thresholds that will allow them the opportunity to kind of grow.
You're listening to On the Money, brought to you by Embassy National Bank. This is Joe Moss, and we're talking to Tom Hogan, who's also from Embassy National Bank, about residential mortgages. Tom is heading up our new residential mortgage initiative, and excited to have an expert doing this for us. And Tom's kind of talking to us about the new landscape of residential mortgages, and we are now talking about the income limitations, the ratios that you've got to meet. So these ratios that you have, irrespective of it being qualified mortgage, non-qualified mortgage, you got to fit within these ratios.
Yeah, I mean
and does credit score have anything to do with it these days?
Credit score does have a lot to do with a mortgage. It's sort of a separate qualifying factor outside of debt ratio. Debt ratio is it's kind of its own little animal that we work with. But credit score is a completely different thing. And the mortgage industry really does set its pricing now on a combination of your loan to value, your credit score, your property type or the transaction type, and then each program is going to have its own parameters for that set of those sets of circumstances in whether or not a loan can be approved. So, to give you an example, the qualified mortgage products, most of the investors will just say, listen, if you can get an automated approval from Fannie Mae or Freddie Mac, we'll buy the loan, kind of bottom line. However, we talked about the portfolio products that are out there. Some of them may say, listen, get an automated approval that shows that it's would be approved but not eligible to be sold to Fannie Mae, and we'll buy that maybe as long as the debt ratio is under 45. But every single loan product that we have out there right now is absolutely credit score driven. I mean,
was there a minimum out there for a while? That wasn't dictated out of Dodd-Frank, was it?
Minimum credit scores are a funny thing. They're really a tricky thing because the truth is there are credit requirements that you must meet outside of just simply a credit score. The number of trade lines that you have to have open, how many late payments you can have in the past 12 months or 30 months, and were any of those mortgage or housing related. I mean, there are just a variety of different things that they'll come at you with that you need to have as credit-related guidelines. It's very hard to meet those guidelines and still have a very bad credit score.
Gotcha.
So, there are a lot of people that will advertise, that will go down to a 580 credit score, a 560 or a 540. The truth is I have not had much success in seeing someone get approved for a loan with a credit score below a 630 or 625.
Okay. So that's just
kind of the bottom line.
Okay. Now, for this ability to repay, if you're a small business owner and most of your income is K-1 income, it may come from multiple different K-1s. It fluctuates. We have a way of taking that and qualifying it under the ability to repay.
Well, ability to repay is more focused on making sure that you are a consistent earner, that you have there's consistency and sort of reliability in what you do. Qualifying people's income is a separate topic. A wage earner will qualify them with 30 days most recent pay stubs, assuming they've been in their line of work for a couple of years, and we support that with the W-2s. With a self-employed borrower or a high commission earner or a bonus earner, it's just the opposite. We actually qualify them over like a 24-month average of their income sources. As long as it's regular and consistent and increasing, it can be decreasing in some instances, but we have to really justify why there was a decrease because, of course, they're lenders like we are and want to make sure that somebody's not on their way out of business, frankly. And then we support that with a current year-to-date financial statement to show that they're on track to actually continue to earn that down the road. So, there's always been this very mystical thing about self-employed borrowers or using tax returns to qualify for mortgages or, those sorts of things. And I can tell you that, it's every day that a good loan officer, and I'm not the only one out there, but a good loan officer that really is doing his or her job can take a look at your tax returns and hear what it is that you do for a living and how you earn your money and qualify you just as quickly as they can by collecting up your W-2s and your pay stubs and crunching the numbers. Because there is a real clear methodology that we use in our business for determining if someone meets the Fannie Mae or Freddie Mac guidelines for income qualification.
Now, if you're out looking for if you want to go buy a house and let's say you're not necessarily a generic. Let's just say you're a generic qualified mortgage borrower. The ability to repay and you're based on your own internal calculations look okay. Should you just go into a Wells Fargo or should you use a mortgage broker?
I think that consumers should use those resources that they feel most comfortable with. Some people will love to go to a Wells Fargo because they've heard the brand name. Maybe they know someone that works at the bank. They have comfort in having such a large company as a service provider. people come to me for just the opposite reason. They come to me because they want to do business actually with me, or they want to come and do business with us because we're a small bank. It's a lot of people feel like that there's like some economies of scale, that they're going to get some cheaper deal elsewhere because of some marketing campaign that a bigger bank may have put on.
You certainly have the availability of more product than Wells may have.
Yeah, well, Wells Fargo is only going to offer, and just their product.
Correct.
Whereas we have the opportunity to have relationships with a variety of different investors. So we have product from 6-7 different investors that we're capable of being able to be able to offer meaningfully. We at Embassy are signed up with 4 currently. We're really meeting the needs of our clients with those 4, and may add some in the future depending on what the inflow is of our consumer base as we grow. We'll go to where our consumers are, and if they need for us to have some other type of product,
we'll find it.
We'll find it.
And a consumer's not paying up for using a broker.
No, there's no difference really. I mean, it's when you talk about a broker, you're talking about simply somebody that's closing loans in somebody else's name. It's like it's like a travel agent.
And the market is going to keep the rates the same, and the broker will end up getting paid, but the institutional guy is going to take less because he doesn't have to pay the origination costs that someone like a Wells Fargo or a Nations Bank, a B of A may have to pay.
Listen, I think for a standard mortgage, it's really hard to find someone that is super cheap, and it's also hard to find somebody that's super expensive. I think that everybody basically pays attention to the market pressures in the market that they're working and really tries to make themselves competitive.
Yeah, and I think unless you're squeaky clean, real squeaky clean, and there aren't many of us out there that are really squeaky clean, I think it's the best deal to go to a broker, a good mortgage broker, so they can find you the best deal for the kind of framework or financial framework that you live in.
I couldn't agree with you more. I think the idea is that everybody listening to this show or watching online is going to be able to identify with something about their overall credit qualifying character, or their package, if you will. And there may be an employment gap. There may be a lack of savings. There may be a credit blip. I mean, they may want to purchase a unique property. Maybe they're wanting to refinance a property that they bought from their mother's brother. I mean, there's all kinds of crazy stuff that happens when it comes to lending. And I think that a mortgage provider that doesn't make themselves available to multiple products leaves a lot of opportunity on the table, because if people don't think that you're a solution, they won't come back to you for fear that you're not going to be their solution. And one of the things that we really insist on at Embassy is making sure that we have a great solution for our customers. We're focused on conventional FHA, VA. We're focused on foreign national business owners, high net worth individuals, and let's not forget that we've got a great program set up for people that are investment property owners.
Right.
We're
doing a lot of things at Embassy, not only for the investor who is redeveloping a house that wants to live in it or sell it or rent it or whatever. We can handle that. There's a lot that we're doing within this whole mortgage realm that's actually pretty exciting.
Yeah, I think the bank's renovation program to me is exciting. It's phenomenal. I think that there is an opportunity for people that have some money to come in and to kind of get into the system and to kind of understand how we do business, and eventually be able to walk out and get deals done quickly and efficiently and make some really good money with the program that we have.
Right. Let's talk about loan amounts. What is the cutoff now for the FHA loan product? Isn't it 437?
No, you're talking the conventional loan is 417.
417.
417.
And what happens if it's over 417?
It's a jumbo loan.
Becomes a jumbo loan. Mm-hmm. That doesn't make it a non-QM. It's still can still be a qualifying mortgage, correct?
That's right.
And you still have to go through the ability to repay calculation.
You do, because it really becomes a function of liability that the investor has. Remember, it's not a function of your ability to qualify. It's really about the investor or the lender being willing to make you the loan.
Correct.
because they're taking on the liability of your default and the consequences that might come on their shoulders from the pool of investors where they're getting the source of funds in the first place.
And it's up to us, the mortgage broker, to put you into the right jumbo product.
Absolutely.
So if you're wanting to come in with a jumbo loan, I think it's important that you get with a really good mortgage broker to put you in the right jumbo product.
And not all jumbos are created equal.
Oh, yes, we all know that.
Okay. I mean, we've got access to some of the thinnest, most fantastically qualified product that comes in at the cheapest possible rates known to man. And we have some access to some programs where they'll take a 660 credit score. They'll take a little bit of a higher debt ratio. They'll allow you we've got a 90% purchase product with no mortgage insurance up to a $750,000 loan size. I mean, there's a lot of flexibility in some of the products that we have available to us that really are what make us special, because it's not just being able to be a good mechanic. You got to work at a shop where you have all the tools available to you to work on all the cars that come in the door.
This is On the Money, brought to you by Embassy National Bank, and we're talking residential mortgages with Tom Hogan, who is starting a mortgage group here at Embassy National Bank. So in the old days, I know that anybody could walk in and put 50% down and get a mortgage. Those days have changed, correct? Or can that still happen irrespective of credit, where the money's coming from, et cetera?
Yeah, no, the secondary market, which is the way that we characterize the fact that we sell loans to other investors, has no product available to it that actually goes through the loan process without qualifying somebody for the mortgage. That just doesn't exist. I mean,
so they're just not making loans anymore on the value of the house.
That's right. There is one of the great things about being part of a bank is that there are, once in a blue moon, an opportunity where we have a phenomenal borrower who has all the ability that we know to show that they'll make a loan payment, and there may be some weird glitch, and we know that they're a phenomenal risk, and that might be something that we would consider doing at the bank, to bridge that borrower over until they could get something fixed or repaired. That brings me up to something that I wanted to make sure that we touch on today. I work with a couple of different real estate groups, and a couple of them in particular. And I've got a methodology or approach that I have for how we deal with people that aren't exactly perfect. And I call it the harvested pipeline. It is not uncommon for someone to come to me and for them to have credit issues or lack of savings or whatever. A lot of other mortgage groups are really geared toward closing that loan that's available to them today. And if the loan is not available, that they consider it really kind of to be a waste of their time. And they tell the folks, hey, call me back in 6 months or a year or whatever. I take a lot of pride in the fact that we've got a program that we've set up where we'll actually give that borrower basically a prescription of financially what it is that they need to do, whether it's achieving a savings level or meeting some sort of a timeline in terms of the stability of their time on the job, or working with God forbid that we do debt side consulting for our borrowers, and we show them a debt reduction strategy that will, over the course of 6 months, not only reduce their debt but also probably have a profound impact on their credit score. And we check in with them quarterly, and we ask them, here, we told you that you had to do these 5 things, and here we're wanting to check in with you on a monthly basis to make sure that you're on target, because you know what, after 5 or 6 months, you're probably going to be, maybe not 6, depends on the borrower, but either 6 or 12 or 18 months, you're going to be in a position to buy your home. And the real tragedy to me is that how many of those folks walk into a mortgage company, and because they don't meet muster, get shown the door and never get really shown how to empower themselves through this home ownership experience.
It is fascinating because at the end of the day, a lot has changed, but then again, not a lot has changed. I mean, what hasn't changed is the fact that you, the consumer, need to sit down with your finances and make a careful decision as to what kind of house you can afford, And over the long term, are you going to be able to afford that house? And then going to and taking advantage of the market and finding to make sure you get the best deal. So in that respect, things really haven't changed. It's really still up to the consumer to try to get the best deal and stay within their means. On the other side, things have changed is that if you're an uneducated borrower, and there are people out there, the first-time homeowners, et cetera, there is legislation in place that keeps a mortgage originator who has no vested interest in the loan. It'll keep them from taking advantage of somebody like that.
Sure.
So, I mean, there are benefits in it, but then again, even if you're a first-time home buyer, I think it's a wonderful thing to try to buy a house, but you need to stay within your budget and don't overreach. So many people overreached, and you can call it their fault, the originator fault, whoever fault it was. The fact of the matter, they did overreach, and we've had a disaster as a result of all that.
I think that how that could be kind of summed up is, it's still about good advice. Mm-hmm. It's still about good counseling. It's still about being able to work with a group that has the know-how, that has products, that has experience and patience, somebody that understands you, that understands what it means to be over-obligated, yet to have kids that want to have a great Christmas, and so you feel the pressure to kind of continue to push out into more obligation. I mean, all of the pressures of, the extended consumer, I think those are unchanged. People still have pressures to spend more than they have. Mm-hmm. And I think one of the things that I take a lot of pride in is, having an approach to working with people where, I talk about prudence, and we talk about, what is affordable. And it's not about, getting in that home while you're looking at that home seems like the end all be all. You got to hang some curtains. You got to buy a sofa.
No, yeah.
And, your kid, by the way, still wants to go to the YMCA and play basketball. So there are a lot of other things that we need to make sure that we're aware of that are, that bring the customer to a point of realizing that this is an important financial decision that needs to be handled outside of the emotion that's usually involved with being in love with a home or that sort of thing.
And quite frankly, the realtor who is showing you the house somewhat incented to get you in a house maybe at the top of your reach. However, a mortgage person, if they're doing their job right, is to put you in the house that you can legitimately afford. And just remember, guys, 5 years down the road, stuff can happen. Mm-hmm. What's the probability? I think there's a probability of going on disability at some point in your life is 30%, something like that. It's, things can happen. You can lose your job. It's a tough world out there these days.
I can tell you, you touched on the relationship that the lender has with the real estate agent. And I can tell you that the real estate agents that I work with, and I do this on purpose, are all geared and have the same philosophy and mindset that I do.
Put them in the right house.
Put them in the right house at the right price. Make sure that they can be a customer for you in the future. Because if you harm them, not only do they go away, but they're going to tell everybody how you harmed them.
Right.
And that's not going to do anybody any good.
Right.
And the folks that, if anybody's looking for a real estate agent, they can come to me and I'll point them in the right direction. Because I do work with several that are awesome.
And we don't get paid for that, by the way.
Absolutely.
So, well, listen, that's our show for the day. Tom, thanks so much we probably ought to do this again. There's still a lot of questions and things about mortgages that we could go through, but I think the message that I hope we're sending is that the mortgage markets are back open. Still a good deal to buy a house. And if you want good advice to get the right house and get the right mortgage, come to Embassy National Bank, and we'll do what's right for you because we like to help people. It's not necessarily about the profit for us, but we do like helping people because in the long term, that's what keeps people coming back.
Yeah.
So Tom, thanks for being on the show today.
Thanks for having me.
What is your cell phone number, by the way, so people can get in touch with you?
404-591-2500.
I don't know how you ever got that 2500 on the back end, but don't lose it.
A lot of being very difficult with a telephone person a long time ago.
Right. Anyway, that's our show for today. This has been On the Money, the #1 small business show on Business Radio X. On the Money is presented by Embassy National Bank. Be sure to follow us on Twitter at _the_money and then the #1. You can listen to any of our shows by visiting the onthemoney.businessradiox.com website and download our shows, or just listen on iTunes. And we're also out there under the YouTube channel of Business Radio X-Gwinnett YouTube channel. So, real good conversation today about mortgages. And Tom, again, I appreciate you being on the show. Until next time, this is Joe Moss at Embassy National Bank. And as we always say, especially now, be careful out there. Leave fear in the back seat, and by all means, stay authentic. So with that, we'll see you next time. Thank you.